Hey everyone, I'm Matt Gordillo, partner and financial advisor at Park Edge Advisors, and welcome to our December Market Insights. I'm joined today by Rich Lowry, partner and chief investment officer of Park Edge, and Gavin Gawecki, portfolio manager at Park Edge Advisors as well. But just a moment for our sponsors, please.
How you doing,
Thanks,
Matt?
guys? Good, Rich. How are you?
Good, thanks.
Hey, Matt.
Gavin,
Hey,
how are
Rich.
you?
Good.
So we're here. I can't believe we're down to the final 2 weeks of the year, practically. Been a fast year as usual, but obviously had some big updates yesterday and recently. And I guess before we dive into that, Gavin, if you wouldn't mind, maybe a recap from our November market insights as to what we talked about last month, just to get people tuned in before we talk about December here.
Sure. We basically back in November, we started calling out this potential rally in risk assets, which we're seeing fully play out now. And it's noticeable when you go to the bottom of market insights and you look at that macro and economic regime outlook, and you see that Goldilocks quad one is in the lead in terms of percent share. So that would be a risk on environment, but it's contrasted by this economic regime score still favoring deflation. And that divergence, when you look to the markets, that's where you could actually see that playing out in real time. And so, that's kind of, what has been happening. I know Rich will get more into, what just happened maybe yesterday in terms of the Fed and things like that. But that's where we are. We have this rally in risk assets playing out, and we'll see, if it has much more to go right into Christmas, or maybe it kind of has a pullback sometime at the beginning of next year.
Let me just add one thing to that. For any new readers of the market insight piece, the sections that Gavin is referring to, the market regime score, is a compilation of what markets are actually doing. And it's based on the notion that if you look across all of global macro, what are commodities doing? What is volatility doing? What are foreign currencies doing? What are inflation swaps, credit spreads, global bond yields doing? The rationale behind it is that those markets have a tighter connection to the real economy than the stock market does. The stock market is dominated by payroll deductions that go into 401ks that get invested in target date funds month after month, and nowhere in the chain of command is anybody asking whether they should change, the allocation. So the idea is these markets will reflect what's going on in the macroeconomy, that informs what's likely to happen with the stock market. So the market regime score is what are markets doing globally across all assets. And the call out that Gavin made is, the rotation to more of a risk-on regime was picked up, in November in the market insights. The bottom-up macro is just bean counting the economic data. So there are a number of features that go into the nowcast. And, there has been a divergence where the bottom-up economic data is saying that the recession is still out there. And even though it's not here yet, doesn't necessarily mean it's not coming. And then if you combine that with the market regime, a risk-on market regime at this point in time is saying, well, we're not going to worry about it this month. For all the, investors out there that are saying, hey, you have to dance while the market or while the music is playing, the market regime score is basically saying music is playing at this point.
Mm-hmm. Well, I think that's interesting feedback, because I heard a mantra yesterday that I liked for this year, which is T-bill and chill. And so, I think that's interesting because what that means is, in relationship to owning stocks versus bonds versus cash or bills. And here at Park Edge, I know we felt the risk reward relationship with equities has not been favorable for most of this year. And obviously bonds suffer when interest rates are rising. And so it's been a commonplace for us to just take that risk-free return that's been offered in short-term T-bills. And so I thought you guys would appreciate that. But, I think as investors, I think it's interesting because, we did see the market correct down 10% in September and October. And then it seems like as Halloween hit, as Gavin was mentioning, the markets, both equities or stocks and bonds, have rallied significantly. I think the bonds are up 10% since the end of October, and the stock market's up about 16%. And so, although there's short-term rallies going on and significant returns that can be captured, you still have to kind of take a look at those insights to say, hey, is it really worth sticking our neck out there? So I really appreciate your valuable insight month to month as we kind of maneuver through this. But on that note, yesterday's Fed meeting was significant, and they have regular Fed meetings, and some are more significant than others. Obviously, they're a very important player and impacting the markets and economy in general. But Rich, I want to see, I'll just kind of wrap up here. Normally I have a couple of questions, but they all kind of roll into one another. One is, give us an update on the major takeaways and why yesterday was such, some people even saying a bombshell from the Fed.
Yeah, I would be in that camp.
A major shift. So I want to give you guys the floor for that, and then how that's going to relate to an outlook for 2024, either for stocks or bonds. And I'll just leave the floor open to you guys. And when you guys are done kind of discussion, we'll just wrap up. But let me give us the update about what happened yesterday.
Yeah, well, I would consider it to be a pretty major surprise in that you had a couple things going on. Well, let me share a slide if this might help. All right, here's kind of a picture. First half of the year, the quantitative tightening by the Fed basically had no impact. And what was going on at this point, which we've talked about on prior sessions, is that we hit the debt ceiling, so there was no new Treasury debt issuance, which means the bank reserves are not draining. With the debt ceiling in place, the Fed had to, or the Treasury had to spend down its bank account. So they're pushing reserves into the system. And the light blue line shows that rates were going up, but risk assets were performing. And that's because quantitative tightening was muted. The big catalyst for the sell-off was the 7/31 quarterly refunding announcement by the Treasury, which said, we're now back in the business of issuing bonds, and they were issuing long-term bonds, which do drain liquidity. So now you had QT working and assets sold off as a result. You now get to the 10/31 quarterly refunding announcement. And the big change here was that Yellen came out and said, we're still going to issue debt, but it's going to be largely in the form of T-bills, for which there is a ready funding source for it from the Fed's reverse repo facility. So that stopped draining liquidity, and markets have, rallied since then. The surprise yesterday was all throughout this period of time, Fed officials went on the speaking circuit and were saying, oh, good, long-term yields are rising, risk premiums are expanding, and markets are doing some of our work for us. So Lori Logan, if term premiums rise, they could do some work for us, leaving the need for additional monetary policy tightening to achieve the Fed's objectives. Chris Waller, during this period, financial markets are tightening up and they're doing some of the work for us. Philip Jefferson, I remain cognizant of the tightening in financial conditions through higher bond yields. Neil Kashkari, it's certainly possible that higher long-term yields do some of the work for us. Jerome Powell, financial conditions have tightened significantly in recent months, and long-term yields have been an important driver of the tightening, et cetera. So that was all Fed speak during this period of time where they seemed to welcome the tightening of financial conditions. Now, for the last couple of months, financial conditions have eased the most rapidly in 40 years. And we kind of came into yesterday's meeting thinking that, Powell is likely to push back against that. If they welcomed financial conditions tightening here, and then they see a immediate turnaround where financial conditions eased, I expected some, pushback by the Fed to say, well, if financial conditions continue to ease the way they have, excuse me, that may leave room, for another hike, or he may reiterate, the higher for longer. And the fact that they really didn't address the easing of financial conditions means one of two things. It means they are assured that a soft landing is here, or they see the rapid slowdown in growth in the fourth quarter relative to the third quarter and think that, hey, if that slowdown continues, but they really didn't mention recession. So I don't think that would be their outlook. The market's takeaway from it is this officially declares soft landing as being here. Looking at market pricing in response to that, you can never say anything is 100% in markets, but soft landing is pretty close to being 100% priced in. And going back to Gavin's, point about, not chasing this, it really gives us a setup going into next year, where if a soft landing is virtually priced in at this point, there's no room for any disappointment on that. Yeah, so if we do get, and we still think a recession is on the horizon. Just because it gets extended and pushed out, doesn't mean it's here. So the rally could continue. There could be year-end flows. There could be year-end rebalancing. There could be other factors that sustain it. But I think it'd be fair to say that at some point we'd be looking to take the other side of this.
Thanks, Rich. And Gavin, do you think what Fed Chairman said yesterday officially means, higher for longer is dead? And if so, then how do we play this going in 2024 if rates are scheduled to come down and we've got investors have a lot of money in short-term money markets and T-bills and those rates start to become lower? Where do you see the migration and outlook for, to play this next lower possibility with rates? And, I'm curious to see what your input is on that.
Yeah, well, I think echoing what Rich said, at this point, I think the market's gotten a little bit ahead of itself. And, the median would be to expect 75 basis points of cuts in 2024. And the market's pricing more than that. Before, when I said, we would use this rally to take down risk, what I mean by that is not necessarily to get bearish, but to say, still look like in equities for the quality factor, quality balance sheets. If you look at the Russell 2000 over the last couple of days here, it is just rocket ship higher. Now, I don't think that's because of this new booming economy that's about to happen and develop here. That's because probably a lot of people are covering their shorts from being short those names. But regardless, taking down risk would mean like in the equity space, look for quality, which still screens as the number one factor for us. And so the way to think about that is even if rates come down a bit in 2024, 75 basis points, let's say, those quality companies, like with the big cash balances, they're going to, be much better positioned for that rate environment, which would be higher rates than we've seen over the last decade than a smaller cap company that needs to refinance their debt. So we would still view that as kind of like the outlook. And in terms of bonds, we would be open to moving out the curve. I know a lot of people are talking about that right now. We've still not gotten those signals, and we're watching them closely every day to see when we're going to start to potentially take a little bit more duration risk.
Okay, well, good. That's interesting comments you make about small caps because, and as it relates to Rich talking about soft landing being an option that, maybe the Fed either believes soft landing is here because, small caps tend to lead out after a recession. And I wonder if the small cap behavior is acting as if, maybe recession was avoided. But, more on that next month. Small caps are big topics in January, beginning of the year. So I think with that, I know we spent a little bit more time in this session than we normally do, but I thought it was important with this significant meeting yesterday, and certainly appreciate you guys' valuable insight, and wish you guys a great holiday. I know we see each other on a regular basis, but we won't do this again until 2024, and we'll get to see where we are, probably middle of January, and boy, I just feel like it could be an exciting, sometimes those are very quiet times in the markets, but with this news, that's certainly a lot of fuel on the market fire, so to speak, I think between now and the middle of January. So guys, thanks so much, and we'll see you next month.
All right, sounds good, Matt. Take care.
Okay.
Take care.